Hmm.
All right. So once again, welcome everybody. 8 of us here today. So we're gonna run as fast as we can. Remember yesterday we finished chapter 2 and we entered chapter 3. And I continue to re-emphasize that chapter 3 is the foundation of insurance. In fact, it's the foundation of the exam you're going to take, chapter 3. The nature of insurance have tell us what exactly happened in insurance, what are we supposed to know. But chapter 3, which is the legal concept of insurance, begin to introduce us into the fundamentals, the foundation of insurance business. If you want to write policy, who do you write policy for? What are the legal concepts? What are the contract called? Who are involved in the contract? So all these and some other things is what we're going to see on chapter 3. However, we have already started in it, but I still plead with everybody to please get it. Any terms you do not understand, just like I said, we are here for discussion. We are here to discuss. Recall us back so we can go back to it. We hammer it until everybody understood it. Because this chapter has a lot of scenario questions. So you need to understand it. Let me see. I think we stopped somewhere here. I can't remember where we stopped. All right, I think we have done electric contract. Of course, we have done that. Contract of adhesion. We have done contract of adhesion. I hope so. Unilateral and conditional contract. We have done all those. I think, yeah. Value contract. All right, we may just start here for for those who are just coming. All right. So contract in insurance is between two persons. Insurance contract is between two persons. Everybody knows that. Normal contracts can be more than 4 people, 5 people, 6 people coming together to write a contract. Where there's a business contract, the business contract can involve 5, 10 people, even 100 people. But in life insurance or insurance contract, it's contract between two people. And because it is contract between two people, in that contract between two people, only one person say he will write the contract. He will write the contract and give you the paper to sign. And that person is the insurance company. Insurance company wrote the contract by themselves, reviewed by themselves, and present it to you, telling you that, look, this contract is the contract of adhesion, meaning either you take it or you leave it. Insurance company does not beg you to come and enter contract with them. No. They do the contract by themselves, they write it, review, and did everything, and present it to public, say, anybody that wants should come in. It's contract of adhesion, either you take it or you leave it. Now you decide to go and take it. You take it, you make an offer to them and they accept. So, in other words, who makes the offer to an insurance company? You, the applicant, made the offer. And the complete offer is the offer you made with the application and their initial premium. That's a complete offer. So the insurance company will accept the offer. If they accept it, it becomes an agreement. It's not yet a contract. It becomes an agreement. They go through your application, probably approve you or deny you. If they deny you, they're going to send back your initial premium. If they approve you, they will now send the contract back to you. In that process, they call it counter offer. They're sending the contract back to you as a contract offer. When they send the contract offer to you, they give you 10 days. And that 10 days for you to go through the offer, go through the contract. If you like it, you'll sign a paper. If you don't like it, you still tell them that you don't like it. They're going to return back your money to you. But if you like it, you have to sign 2 papers. One of them is a condition stating that, look, my head is still remain the same. And the other one is what? A delivery receipt. That delivery receipt showing that, look, this policy has been delivered to you. So those 10 days they give to you is what we call the free look period. Free look period, always, I want people to always have piece of paper and a pen. Whenever you hear me say anything period, please write it down, because we have a lot of periods, we're gonna meet a lot of periods. And in the exam, is always a confusion to people. Which one is this period? What is the meaning of this period? So this is the first time we are mentioning period, and we're gonna see a lot of it. So I want you to write free look period. Free look period. In the exam, you may see it that way. Free look period is what? The time you have to go through your policy. It's always 10 days. You look at 10 days when the policy is delivered to you by the agent. It's 30 days when the policy comes to you through your mail. So always look at those days. It's always bring confusion. 10 days when the policy is delivered to you at hand. Somebody bring it to you at your house. That is 10 days free look period. Then 30 days free look period is when the policy was delivered to you through the mail. You get the policy through the mail. So that is free look period. So if that free look period is when you confirm yes, you want it. If you sign those two papers, send back to them, what happened now is a contract, and it becomes a binding contract. You can no longer make changes to it. However, most companies, insurance companies, because they want to make sales, they can still tell you, they give you 2 days or 3 days or 1 month, depending on the insurance company, which you can easily effect changes in terms of the face value, changing or probably changing another thing like beneficiary or that. However, changing of beneficiary can come at any time you want to do that. So that is that. Now, that is insurance contract. Now, why do we say insurance contract is a value contract? Because it's contract that have unequal value. Unequal value. What you benefit is unequal to what insurance company benefits. So because of that, insurance contract is a value contract. Regardless of whatever happened to the loss, the contract is always not beneficial to the insurance company. That's the truth. Except you have something like a term insurance where if the policy terms, what happens? You don't have any return of premium rider, you lose everything. But in insurance, it's a policy with a cash value. It's not always like that. Imagine Mr. B. Mr. B have a policy. He wrote a policy today. This is February 7th, and he paid his premium for February 7th. This is March 7th. He pays his premium for March 7th. By April 7th or April 8th, Mr. B dies, or Mr. B is diagnosed with cancer, or Mr. B have something to do with anything that is contrary to the previous good health he has. He can file a claim. If he files a claim and is justified, the insurance company doesn't have no option than to pay him the claim. Assuming that Mr. B has a $1 million policy, and in that $1 million policy, his premium is $700 every month, and he has paid $700 for this month, which is March. By April, he was diagnosed with such sickness. Mr. B will go and make a claim of what? Let's assume it's terminal illness. He has to make a claim. If you make such claim, they're going to pay him 90% of his death benefit. And 90% of the death benefit is $1 million. 90% is how much? Almost $900,000. So he gets that $900,000 for the fact of paying $700 for the month of March. So that is why we say contract is unequal value. That we call it allotric contract. So please remember that it's an allotric contract because it's contract of unequal value. I want everyone not to forget that. Now, when a contract is said to be value contract, it's paid the sum regardless of actual loss. So you come to that later contract, regardless to contract of unequal value too, then regarding to what happened when that policy is paid. They didn't pay that policy based on how much you have paid as a premium. No. No. And this amount has been predetermined, known. Unlike when you have insurance in your cars, insurance in your homes, when there's a damage in your car, they will come and estimate the damage, the loss, and pay you, reimburse you. That's when we say reimbursement or indemnification. Yeah. But in life insurance contract, the contract has only been predetermined. The amount, the benefit has predetermined, and you cannot get that benefit without an actual loss occurring. So it comes back to what we said yesterday about consideration. What we say, we have three elements of consideration. One is the consideration on the insurance company and the consideration on you, who is the applicant. We say the consideration on the insurance company remains what? They promise to pay the benefit or to pay the claim. The promise is a promise. Now, the consideration on your own part, which is the applicant, is what? The application, and again, the initial premium. So these three factors are what make up the contract. When any of these factors are not there, we say the contract is void because there's no contract. So in any contract that does not exist is a void contract. Then the voidable contract is a contract we have already known, established, and at the point, this contract maybe either of the party did not involve himself in paying the premium, which means you refuse to pay your premium, that contract will be voidable. But a void contract is contract that does not have terms established on it, which means the three elements, one is missing. That is a void contract. I'm trying to go back to what we said yesterday so that people who are not here yesterday can be able to follow us. So that is insurance. Life insurance contract are value contract. There is no attempt to calculate their benefits at the time of death. It is all already established. It cannot regard it to insurance in your car, insurance in your home. If anything happened to your home, they will bring estimators or adjusters to come and look at it. If they look at it, they will not bring out the amount, that is amount of the damage, which they will pay you. That is what we call indemnification, or you paid you back. They try to bring you back to your original position before the loss occurred. That is what indemnification. That will happen in other insurance, but in life insurance, it's not like that. Because what? The benefits, the death benefits have already been established before the loss occurs. So that's why we say life insurance is a valued contract. Now, let's go to contract of indemnification. What do we mean by indemnification? I want everybody to have this mind, because most times, upon our education, upon our understanding, we are still confused when we hear the word indemnification or the word indemnity. It only means reimbursement. It only means payment. It can also mean deductibles. So please just have it in mind. You hear the word, you see the word indemnity. They're talking of payment. They're talking of reimbursement. They're talking of deductibles. What are the things they're trying to reimburse you? Of course, financially, whenever you hear indemnity, what it means, they are trying to bring you back to where you are before the loss occurs. And this exactly happens when you have damage in your car, damage in your home, damage in your properties. Indemnity does not involve with what? Life insurance, no. Because in life insurance, benefit is determined when the contract was signed. But in the contract of indemnity, the damage is estimated, and they will pay you according to the loss. So you can see the difference. So an indemnity contract pay amount equal to a loss. They are not expected to have any gain in indemnity compensation or indemnity reimbursement. No, they pay you exactly what the loss equals to. So an indemnity contract has one simple goal: to return you to the same financial position you had before the loss occurred. That is the goal of indemnity. For example,
indemnity I pay about the same amount now.
Somebody speaking?
No? That's okay. Sorry.
All right. So let's say, for example, if your car sustained $5,000 in damage and the indemnity contract pays you $5,000 for repairs, some contract indemnity are reimbursed policy. So your damage is $5,000, they must pay you $5,000. It's not the same with life insurance, in which you agree to sign in, buy a policy of $500,000. If there's any loss, the death benefit is $500,000. Then let's assume you have riders on the contract you sign in life insurance, maybe chronic or terminal illness rider. If such sickness occurs, it will pay you 90% of the death benefit. So you can see that all this thing has been predetermined before the contract was even signed. In fact, it's part of the thing you sign in the contract. That's why if any of you have a policy here, go and check on your policy summary. That will give you every details of your policy, what it takes and what are involved. So that's quite different from indemnity. Indemnity involves your property, your cars, and all the things that follows. So let's look at this exam tip. Say, remember, value contract pay predetermined amount like 500,000 life insurance policy, while indemnity contract pay based on the actual loss. Life insurance is always a value contract. You can't calculate the actual loss of a life. No matter what happened, there's no way you can put a pen on paper, begin to calculate how much this life worth. No. It's quite impossible. So let's look at these policies. It's a predetermined payment based on predetermined, which is in a value contract, payment is predetermined amount. Life insurance, accidental death and dismemberment policy, which is all of them are value contract. Established when this one, benefit calculation established when the policy is issued. Proof required, death specific event, and purpose was specific sum guaranteed. All those things is just they're telling you the thing that are regarded a value contract. You do not need to go and begin to calculate the amount involved. In indemnity contract, actual loss amount will be paid. For instance, auto insurance, home insurance, disability insurance, all those are indemnity contract. Calculated at loss, extent of what? Actual loss, and restore the pre-loss conditions. So if you have a damage on your car, they will come and estimate it. They'll find out how much involved to make your car back to how it was before you had that loss. Now, insurable interest. I think we did this in yesterday, but we're going to move fast on it. Insurable interest. You do not go along the road and see somebody and put insurance on that person. No. The person you put insurance on is the person who you will lose money on if anything happened to that person. If such a thing happens, now means you have insurable interest on that person. Now, who do you have insurable interest on? You have insurable interest on your brother, your children, your sister, your husband or your wife, your grandmother, your grandfather. Those people around you who you know, if anything happened to them, you will have a financial loss. That are the people legitimately you have what? Insurable interest on. You cannot put insurance, buy insurance for your neighbor or somebody passing on the road. No. Because you cannot do that because you don't have insurable interest on them. Now, let me ask this question. Do you have insurable interest on your employee? If you're an employer, do you have insurable interest on your employee? Of course, yes. You have insurable interest on your employee. Because if anything happened to your employee, you will have a financial loss. You may not have immediate financial loss in the money terms of contributing to the burial. You may not. But if you like, you can still do that. But however, indirectly, your business is being affected, meaning you have a financial loss. So that is why you have insurable interest on your employee. And based on that, they allow you to put what we call key employee policy for your employee. Yes, and you can put executive bonuses for your employee because you have insurable interest on them. Now, let's look at those things you have insurable interest on. It said, This simple rule is this: you can only insure what you can lose money on. Anything you can lose money on, that's what you insure. Can you insure your car? Can you insure your phone? Can you insure your fridge? Those things you have insurable interest on them. Or your own life, you have insurable interest on your own life because family depends on your income. So you can insure yourself, buy policy for yourself because you have insurable interest on yourself. Your spouse, of course, your husband and wife, if anything happened to them, you will contribute financially to it. So you have insurable interest on it. Then your dependents, which is your children, of course, anything happen to your child, you'll be responsible. So you have insurable interest. Your business, of course, you can insure your business because if your business stopped today to produce, you are financially in trouble. Your employee, you have insurable interest on them. That's why you can put policy on them. These are the things you cannot insure because that they don't affect you financially. Your neighbor's house, because you don't lose money if it is burned down. Your male carrier's life, because there is no meaningful impact on you. A stranger's life, those you see on the street walking, you do not have insurable interest on them. A car you do not own, because it's not your financial loss if it is damaged. So those are the things you don't have financial responsibility on, and meaning you do not have a insurable interest on them. So it's left to you to understand those things you have insurable interest on, and the things you do not have insurable interest on. They may come as a scenario question. So if you understand what insurable interest means, if any question comes on that, no matter how they twist it, you understand and you get it right. So that's what it is. Now let's go to, this is still insurable interest. We have said much about that. We cannot continue on that. Negotiation and issuing insurance policy. Yes, this is where we start, and this is where everybody should pay more attention. You become an agent. Remember, I said an agent is a producer. An agent is what? A field underwriter. So your name is what? As I am now, I have my license. I'm a producer. I'm an agent. I'm also an field underwriter. Why do they call me a field underwriter? Because I'm the first person to call to talk to a customer. I finish the application with the customer before I can submit it to the underwriter in the office. So in insurance business, there is two underwriters. One is the underwriter in the field, which is the agent or the producer, and the second underwriter is the underwriter in the office. The underwriter in the field, which is you, will now prepare the application with the client and send to the underwriter in the office, who will now go through all the numerous things they will do there, which we still see before they can approve or deny the policy. So let us go back to insurance policy. It's always it's a written contract between two parties. Who are the two parties? The insurance company and what? The owner of the policy. The owner of the policy, as we say, can also be what? The insured. Let's assume in exam, if they bring you this question, which they always like to bring to confuse people, they bring you the insurance contract is between two people. Who are they? They put insured. They put policy owner. Now they put the insurance company. Of course, contract is between what? The insurance company and the policy owner, not the insured. Please. If they bring these two, insured and policy owner, please, life insurance contract is a contract between the insurance company and the policy owner, not the insured. Except they do not bring the policy owner. Except there is no policy owner, they are meaning the insured, because sometimes the insured is the policy owner. So please don't get confused with that. But if they bring the policy owner, bring the insured as the option, choose policy owner, not the insured. Then if they do not bring the policy owner, what it means that is the insured, because sometimes the insured is the policy owner. Yes, sometimes the insured is the policy owner, and sometimes the policy owner may not be the insured. So these are the things. Don't get confused with it. If you are the policy owner, if you write the policy for your children, for those who you have insurable interest on, you are the policy owner. Why they are the insured? Those people you have insurable interest on does not have right to that policy because they are not the policy owner. They are the insured. Those who pay the piper, they take the tune. You are the insured. You are the policy owner. You pay the premium, meaning you have right on the policy. You can take a loan from the policy. You can make a withdrawal for the policy. You can change the beneficiary. But the insured does not have the right. The contract is between you, the policy owner, and what? The insurance company. Meaning the insured and the beneficiary are not part of the contract. Please. The insured and the beneficiary are not part of the contract. The contract is between the policy owner and the what? The insurance company. So an insurance policy also refers as an what? Insurance contract. The term can refer to overall agreement between what? The insurer and the insured, as well as a policy formed without any optional provision. A policy rider or endorsement is legal attachment amendment to a policy. Let's talk about the policy rider. Most often, policy rider is not part of the contract. A policy rider is something they bring into the policy to make it look beautiful. Let me just say what policy rider is. Let's assume I went to buy pizza with Chi. I want to buy pizza. Two of us drive to a Pizza Hut. We want to buy pizza. I'm trying to demonstrate what policy rider is so that I can use it to understand it anytime. A policy rider. Let's assume I want to buy pizza with Miss Chi. Two of us drive into a Pizza Hut. We agreed on a car when we were going there. We're going to buy veggie pizza. That is vegetable pizza. Now, when we get there, the real amount of vegetable pizza is what? $20. Now, I bought my own $20. I paid them $20. They gave me a pack of vegetable pizza. Miss Chi, being a lady, she don't want to eat like me. She want to keep weight. Now, she decided that in that vegetable pizza, which I have bought my own $20, she decided that she want to add every other ingredient on her own. She add pineapple. She add cucumber. She add meat. She add onions. She add vegetables. She add all those things on her pizza. Is she going to pay the same amount with me?
No.
Huh?
No.
All right. So that is what those things she adds on her own pizza is what we call the rider. That's a literal example of what rider is. But me, I've taken my own. I still have a policy. And Miss Chi has a policy. But she has riders on her policy. Me, I don't have riders on my own. I pay $20. She may end up paying $50 or $60 on her own because of the rider she decided to put on her own. So therefore, when you are writing a policy, you are going to design it based on your family needs, based on your needs. You do not write policy based on another person's need. You write insurance contract based on your policy need. That's what that means again is this. Now that you have come to understand this, definitely when the knowledge expands, you will now see the need to not to undersure yourself. You see the need to put on more policy for your life and for your children. You will see the need. Honestly, I'm telling you the truth. If you have 500,000 policy now, you may think it's enough. It's not enough. When you get to understand what we understood now, you will see the need to buy more. Yes. So then when you are buying those more you are going to buy, you're going to design it based on your now knowledgeable understanding. You're not going to buy it as you bought it before. No, you're going to buy it, design it the way you want it. As Miss Chi went to Pizza Hut and adds so many riders to make sure that the pizza is so healthy for him. So as you will then go to buy a policy and put riders that will be beneficial to you and your family. So that's what insurance policy is. Meaning, if I go and buy $500, another person buy $500, don't expect us to pay the same premium. Even if we have our risk classification is the same. Remember the 3 risk classification we have as far as this exam is concerned. We have what? The preferred, the standard, and the substandard risk classification. Those three risk classifications are what determine the premium we pay. I hope everybody still understand that.
Yeah.
The preferred, the standard, and the substandard risk classification. There's the three risk classifications, and that determines the premium we pay. So this policy rider is a great thing to add to a policy. In fact, this is the foundation of why this great understanding about insurance come to make meaning to us. If you remove the riders, the policy now becomes just like as it is to term life insurance, where everybody will just buy, including me. I bought my first term life insurance in 2007 without knowing what it means. I hear insurance, I buy. Knowing that the most expensive policy you can buy is term life insurance, but people don't know. But those who are selling it to you will come and tell you that, look, it's the cheapest, it's $20, it's $30. Believe me, is the most costliest policy you can buy. Yeah, yes, you can buy it now, it's $20. What if when the policy terms, they're definitely going to give you 20 years term or 15 years term. Highest, they will give you 30 years term. I got my own 30 years term because I was still younger then. I got 30 years term. If you go now, they will not give you 30 years term. They give you 20 or 15 years term. Then when that policy terms, you want to renew it, they will not tell you the price of insurance. So a policy rider or endorsement, they call it policy rider or endorsement, is a legal attachment that means a policy. Look at this word. It means a policy, meaning it gives more good, it give it more, a good aroma, it makes it more beneficial. So the rider often incorporates additional benefit into a policy. Some riders limit policy benefit to allow coverage for high-risk situations. You know, in life insurance, you have almost 4 riders: critical rider, chronic rider, terminal rider, and long-term care rider. Yeah, that's the 3 riders you have. 4 riders you have. Can you get 4 of them at the same time? No. They may automatically give you 2, terminal or chronic, but they cannot give you chronic and long-term care at the same time. So, however, meaning you can go on your own and buy a policy, long-term care policy, which is, we recommend, that is very wonderful for anybody to have. If you have extra money, get it, it's good. You don't want tomorrow when you get old, your children will take you to nursing home because they don't have nobody to take care of you. No, you can get long-term care policy that takes care of you. When I stay at home and still the smelling of our home until the last day the person will pass. So the application is part of the insurance contract. You get to bring the application and initial premium. That's what makes it a contract. Application is part of the insurance contract. Initial premium is part of the initial part of the insurance contract. The promise to pay benefit is what? Part of the insurance contract. They are called consideration. Please. Now, ultimate good faith. Remember, finance is the most regulated thing in America. Please, I keep on emphasizing on it. Since after the 9/11, it becomes sometimes so difficult for people not to pay attention on it, because Americans now begin to look at it as a source of terrorism financing. Because of what? Remember the 7-pay? Some people can get millions of dollars and put a life insurance, put their 7-pays. Their 7-pays may amount to 1 million, to millions of dollars. So they assume, or they said, 9/11 was somehow financed by terrorists through life insurance. So that's why they introduced a whole lot of things, AML, ERO, and all teachings about life insurance. Now, meaning you as an agent do not attempt to what? Conceal, disguise, or deceive anybody. You have to do it as it is, meaning avoid anything that is not in utmost good faith. You must do everything according to the law. A consumer purchases a policy may base on insurance agent's explanation of policy features, benefit and advantage. Do not lie. Say it as it is, please. Do not say you know why we don't say insurance is insurance is an investment. Life insurance is not an investment, please. Everyone should know that. Even though it has a protection portfolio and investment portfolio attached to it, but it's not an investment. Because if you say life insurance and investment, people will go when they buy 500,000 policy, they pay 1,000. Tomorrow they will call you, say, look, this is my policy. This is an investment. I want to withdraw 200,000 from the money. Meanwhile, they pay $500 as premium for the first month. The next month they call you that they want to withdraw 200,000 from the 500,000. It's not what they call it. Which this one that just scooter. It's not scooter. Please, it's not scooter. Life insurance is not scooter, please. Because if it's scooter, you'll not be here trying to get your license to do the business. No. You just jump into it and they just recruit you. You start doing the job. It's not scooter. It's a very serious business. The same people who organize exam for medical doctors, exam for nurses, exam for nurse practitioner, are the same people who are organizing this life insurance exams. So please, we should take it serious. We should protect our license the way we are protecting other licenses we have. So an insurer issued a policy on the fact that the application was truthful. The underwriter in the office will issue a policy to you knowing that whatever that is the application is truthful. So any deceit, any disguise, any conceal of information that you know that will change the risk level is an offense. If insurance company find out, they will do what? They're going to cancel the policy. Of course, that's the truth. So concepts related to ultimate good faith include what? Warranty, representation, and concealment. So we're going to see these three words. They're always there in exam. A warranty is not, you cannot warranty anything. Remember, the application you fill is called representation. That's what, that application you sit down to fill with the agent online is what we call representation. So you cannot say that representation is warranty. No, you cannot guarantee it. It's a representation which is to the best of your knowledge.
A true statement.
Yes, it's to the best of your knowledge. So you cannot warranty it or say, I guarantee that this statement is correct. No. Because remember, even your name, spelling your name may be wrong. Your date of birth, you may miss one thing on it. Your home address, you may miss one thing on it. So because of that, they said your application is regarded as a representation of you, which you did to the best of your knowledge. So the application is regarded as a representation in life insurance contracts, which you cannot warranty or guarantee. No. Concealment is when you decide to conceal those facts that you think that is beneficial to you, that makes you not to get the supposed risk level grading. You know, remember what it means? When you get a lower risk grading, you have a low premium. So if you do such, it's not good. Please, you have to know these three words. So your application is what? A representation is not a warranty. A concealment is regarded as an offense in life insurance business. Please avoid them. Now, the warranty is just what we are saying. A warranty is a statement guaranteed to be true. You cannot guarantee your statement, the application is true. Please, you cannot guarantee that. You cannot warranty that it's true. No. It will become part of the insurance contract. If the statement is not true, the insurance company can cancel the whole contract. So a warranty are presented to be material because they affect the insurance decision to what? Accept or reject an application. A warranty can be expressed or applied and may relate to past. Express or implied. Express or implied. We're going to see that after now. Remember, we are going deep into contract, what contract means. So generally, applicant statements that are treated as warranty appear in some lives, property and casualty coverage rather than life and health insurance application. So please do not warranty anything, please. So therefore, because of that, they said all your application is regarded as a representation. They are not warranties, please. Statement made by applicants. Let me really see it. Statement made by applicant words for insurance are representations, are not warranties, please. So a representation cannot qualify as an express provisions. So we're going to see implied, express. We're going to see them. So a representation cannot qualify as an express provision in contract of insurance. One thing to take home here is that an application is a representation. They are not warranties, please. That's the take home. That's what you can see in exam. Let's just save our time. So exam tip, questions often present a scenario. Most of these things will come as a scenario question. So you understanding them is good for you. And then we ask whether a policy is automatically void, warranty, or potentially voidable representation. Everybody know what void is, and everybody know what voidable is. In a void contract, meaning there is no contract. In a voidable contract, meaning there is a contract before it is voided. A void contract is a contract that lacks one of the elements of a contract. Those elements are the three considerations, which are what? The promise to pay benefits, the application, and the initial premium. So if any contract lacks one of these, is a void contract. It's not meaning that contract does not exist at all. But a voidable contract is a contract that already have these three elements, and the point, one of the elements is missing. For instance, you are paying your premium, you pay your premium this month, you pay next month, by April, by May, you don't have money to pay again. And after May, June, they cancel your policy. What happened? That policy becomes avoidable because one of the elements, which is what payment of premium, was missing. So that's what all of us should know. Let's not waste our time on this. Concealment, it do not conceal any material fact, please. Concealment is defined as a failure or neglect by the applicant to disclose a known material fact when applying for insurance. You are applying for insurance and you lied. You have high blood pressure. You lied, forgetting that this information will be seen in your MIB. This information will be seen when your provider send the information to them. May type in your name and social security in the MIB record database. It will bring out everything about you. So why do you lie? Say the truth. So most policies are cancelled. Most policies are denied because of this material fact being hidden. You do not say it. When you do not say it, it means that you hide it. So you save them time by saying it. When they are reading, going to your application, they saw it, than allowing them to go and discover it by themselves. That's concealment. It's an offense. So another word is rescission. It means that the contract is made null and void. Rescission. Null and void meaning that it doesn't exist. So we're not going to go through all these things. Now, void contract versus voidable contract. We have talked about them. Void contract and voidable contract. At least everybody understand what void contract is, and everybody understand what voidable contract. Voidable contract means that contract is existing before one of the elements is not there. Voidable. Void contract, it means that there's no contract at all in there. Please. Cancellation and fraud. Can you cancel your policy? Of course, yes. You have the right to do that. Cancellation is a voluntary act of terminating an insurance contract and referred to as cancellation. It's a voluntary termination. You can wake up to say you want to cancel your policy. Yes, you have the right to do that. One thing that people don't know is this. When you cancel your policy, you are losing money. One, Two, you are losing considerations. You are losing age, because remember, age matters. Three, your medical record may not be the same. So you may go back to get that policy back. You may not get it back. That's the truth. I normally give example of a lady. In fact, that was the first, the second claim that we filed since we started the business. That is the second claim we filed since we started the business. This lady lives somewhere in Georgia. Now, this lady wrote a nurse that's working perfectly. She was making good money. Single lady. She wrote $1 million policy, which Dr. Ruth wrote for her. $1 million. I'm not telling you a story. I'm telling you what I witnessed, what I see, what I was part of. So she wrote $1 million. Then after about, she paid her first premium. She paid annually. Then within 2 months, she called. She called Dr. Ruth and said, look, I want to reduce this money. I don't want to buy 1 million. I want to buy 500,000 policy. We thought it's a joke. She made it. Dr. Ruth asked her why. He said she had found out from some of her friends that it's too much, that she don't really need the $1 million policy, that she got the advice from her friends. There's nothing you can do. Insurance company Transamerica was called, and they reduced the policy to what? 500,000. What I'm telling you is within 2 months. I'm telling you what I see. It's not a story from another person, it's a story from me. So her policy was reduced to 500,000 from $1 million she bought. Within 2 months, she called again. By the time the policy has been reduced to 500,000, within 2 months or 3 months, she called again. Can we now take that policy back to $1 million she was before? Of course, it's not possible. So we call insurance company say it's not possible. We told her that it's not possible. Say we should call and try. We called the insurance company, say, oh, sorry, it's not possible. You can write new policy. So she now told Dr. Ruth, all right, can we now write another policy of 500,000? That policy was written and that policy was declined. After about 3 or 4 months, she wrote the first $1 million. She reduces 500. We wrote another policy. After that period, the policy was declined. Not knowing that this lady has gone to hospital and was diagnosed of breast cancer. So, you see, sometimes we make decisions, personal decisions that affect us. We allow other people to intrude into it and disorganize our God-given intents. We allow people to suggest to us that things that concern us. We allow them to come into it. So, of course, the policy was denied. And as a nurse, she don't save enough to go and take care of the hospital bills. So she now says she wants to file a claim. So based on council put another policy, those kind of things, it becomes suspicious of what's going on. But initially, we don't know. Until when she now say, we're going to file a claim. Before you tell your agent to file a claim, you must tell your agent the reason of filing the claim. So there was doubtful whether they will approve it or not. The claim was filed. Finally, luckily for her, it was approved. She was paid 350-something thousand because of terminal illness. She was paid almost 90% of the money. So this lady, after getting $360-something thousand, she went ahead and paid $210 to her house and used the remaining, go and treat herself. She went to Anderson Cancer Center and did the mastectomy, which helped her to remove the cancer from her breast. She did it good and was good. Today she's working and her house has been paid off. She's okay now. She's cancer-free. So, you see, sometimes, imagine this lady getting home with close to 900,000. You just imagine what it would be. she get home with close to 900,000 instead of 300 and some thousand. Get home with close to 900,000. You know what it be?
A question.
All right.
Okay, can she get another policy again now that
Of course,
she's
no.
over that? She
Of
can
course
never
not.
get another.
Until after 5 years.
Oh, okay.
That's a long time.
Yeah, until after 5 years. And remember, after 5 years, she must added age.
Yes.
How are you sure there'll be no problem again within that 5 years? How are you sure before that 5 years there'll be no hypertension and diabetes?
Wow.
So that insurance is something you can get when you need. In fact, when you don't need it, you get it. But when you don't need it, you will not get it. That is the fact.
I think it's good that if you have a policy at a certain amount, it's good that if you start getting cash value, you keep increasing it when you're still healthy and at your earlier age, because
Yes.
you never know what's going to happen.
You never know what's going to happen. But if you don't understand, if you don't have the knowledge, you won't even do that because you don't know what it means to do that.
Yeah.
Yeah. If you don't have if you don't have the knowledge, to you, it looks like you are wasting the money.
Yeah, exactly.
That's what it is. But when you know it, someone like Daniel has one single policy of 50 million.
Wow. I never heard that before.
Huh?
I didn't even know what he has in policy. I know he's been doing this for a long time. Imagine.
He has one single policy of 50 million.
He never talk about his policy.
No, he cannot tell you now because we are inside. That's why I'm telling you. One. Not, in fact, if you put all the policy in her home, you're talking about close to 200 to 300 million.
Yeah, that's a lot.
So that's what I'm saying. When you begin to understand this, that's when you now expand yourself. Look, you're building wealth for generational yet unborn.
Yeah.
Because definitely one person must die one day. There's no two about that. So cancellation, you can wake up to terminate your policy, just like that lady I just told you guys the story. You can decide to terminate. You can decide to reduce it. You can. The policy owner may voluntarily cancel an insurance contract for any reason at any time. A policy will lapse if the premiums are not paid before the end of the grace period. Remember what grace period is? Grace period is the period in which you are allowed without paying your premium. After the grace period, your policy will be terminated.
Will lapse, yeah.
Grace period is even involved in every bill you are paying. Bills, the electric bill, your water bill, your mortgage, all of them have grace period attached to them.
Yes.
After the grace period, they'll cut your light.
Yes.
After the grace period, they'll cut your water. After the grace period, the mortgage people will send you more.
If I ever get a eviction from your house, after the grace period.
After the grace period. So everything will do have a grace period. So in a life insurance, the grace period is always 1 month. Please write it down. In life insurance, grace period is 1 month, which is sometimes some people will say 30 days.
30 days in Texas.
30 days in Texas, but most
sometimes you see 31.
Sometimes you see 31. But most states will say 1 month, which is 30 days or 31 days. Of course,
it depends on the month.
Yeah, it's depends on the month. So please, everyone should know that. Write it down. Is something that I'm confused. Remember, we have talked about 2 periods now. We have talked about free look period. We now talk about grace period. All of them mean different things altogether.
Yes.
So let's talk about fraud. Of course, you don't want to involve in fraud when you are into this business because we come back to haunt you. That's the truth. You don't want to involve with fraud, it will come back to haunt you. Do it as it is. This is not a 419 business. This is not business you come and begin to use basket to pack the money. Do the right thing, please. Nothing like fraud. Don't you get involved with it? So fraud involves deliberate or intentional deceit with the objective of making false statement to be compensated by an insurance contract, e.g., filing a false claim. You must show a proof of loss before you file a claim. You cannot just file a claim without a proof of loss. That's why in life insurance, they always want you to bring this certificate. That death certificate is what? The proof of claim, proof of loss. So contract may be rescinded if any party engages what in fraudulent conduct. Of course, everybody know that. So under most types of contract, other than life and health insurance, fraud is ground for voiding a contract. Of course, it's a ground for voiding a contract when contract is cancelled. The insurance company, if you commit a fraud that known, insurance company can void their contract by they'll cancel it. Meaning, when they say void their contract, remember what we say void. Void is that there is nothing there. It's no longer a contract. The insurance companies try to void their contract means that they are removing one part of the element of the contract, the three elements, which means if insurance company void their contract, meaning they are removing the promise to pay benefits. And if they remove the promise to pay benefits, is it still a contract? No. The three elements are no longer there. What is there now is the application and the initial premium. And of course, they remove their promise to pay the benefit, they will give you your premium back. So they have voided the contract. But are they going to give you all the premium you paid? No, my brother. They're not going to give you all the premium. They're going to do calculation and remove the cost of business. Whatever remains is what they will give you. Yes. But in term insurance, if the term insurance does not have a return of premium rider, they will not give you nothing. When the policy term it does not renew, your money go. Luckily enough, you have a good agent who wrote the contract for you, and remember that you have to put return of premium rider. When your policy term you could not be able to renew, they will do what? Give you back your premium after removing the charges. So in insurance contract, an insurer may have only a limited time to do what? To challenge the validity of a contract. In most states, insurer cannot void a life insurance contract after it has been enforced for 2 years. Of course. So I was going to talk about two terms now. I want everybody to write it down. Contestable and incontestable. Contestable and incontestable. If you have your pen, write it down. Contestable and incontestable. Let's talk about the contestable. These are exam questions. I'm telling you, you have to remember it. Contestable and incontestable. When you write a policy, the first 2 years, it is what we call contestable. We normally say contestability. Contestable is the first 2 years. After the first 2 years, that your contract becomes what? Incontestable. On the first 2 years, which is the contestable, the insurance company have the right to contest, have the right to cancel your policy. During the first 2 years, they can void your contract, giving you any reason to void cancel your contract within the first 2 years. That is contestable. Then after the contestable, we enter what we call the incontestable period. The incontestable period, the insurance company does not have any rights whatever to cancel your policy, except where there's a concealment or misrepresentation. Meaning, the insurance company cannot deny you a claim after the contestable period. The contestable period of 2 years, when the law they give them the right to investigate everything. So after that, they do not have the right to cancel your policy. Please note these two events that are good. So guarantee renewable is also seen in every policy. Health insurance policy typically allow 2 or 3 years. So, but in life insurance is 2 years, but in health insurance is 2 or 3 years, depending on the states. In health insurance is 2 or 3 years. That is contestable period. Is 2 or 3 years. So you have to find out what your state requires in contestable period. Is it 2 or 3 years? But in life insurance, it is what? 2 years, please. In life insurance, contestable period is 2 years. In health insurance, contestable period is 2 to 3 years, depending on your state. So it's left to you to go and find out your state law, whether it's 2 or 3 years. Texas is 2 years. Please, find out your state, whether 2 or 3 years that your state allows. Just like when we say year of maturity. Year of maturity differs from one state to another. Texas is what? 18 years. New York is what? 14 and a half years. Which other?
When you say maturity, is it maturity of what?
To enter a contract.
What kind of contract?
Life insurance. In fact, if life insurance, but even any other contract.
Oh, okay. Yes. Okay. Yes.
Life insurance, even if we can extend it to any other contract, yes. Any other contract is 18 years. Life insurance is 18 years in Texas.
Age 18 years, okay.
Yeah. New York is 14 and a half years. In case you're from New York, it's 14 and a half
years, you can get a policy.
Of course.
Wow.
All right. So, the ability of insurer to void other health insurance policies due to fraud is not necessarily limited. This will be examined later in the course. So we're going to see a lot of it, that contestable and incontestable period. Please remember it. Now, waiver, of course, in life insurance, you can waive your right. You can waive your right. You can try to cut your right to another person. Remember when we talk about policy owner and insured, we say the insured is not the same as the policy owner. And sometimes the policy owner is the same as the insured. When you buy a policy for somebody, you are the policy owner, that person is the insured. When you buy a policy for yourself, you are the insured and also the policy owner. Then, if you are not the policy, if you're not the insured, but you are the policy owner, at a time you may decide to give back this person his policy. At that time, you are giving him all the right to take care of the policy, meaning you waive your right to that person. However, a waiver is a voluntary surrender, that is giving up of a non-right. A waiver is also defined as deliberate, voluntary, or intentional abandonment of a non-right by the insurer. It usually involve the conduct of insurer or its sales representative, which intentionally relinquish a defense against a claim. You see, I've told you guys why insurance companies do not want to enter into case with anybody. I said that several times. Even involves both the contract in your auto insurance, contract in your homes. Insurance company never want to go to court with you. If you have accident today, you call them down, maybe they don't want to pay attention to you. You call them, you tell them, all right, meet me in the court. They will call you the next minute. They want to settle out of court. Yes, because what? Remember, it's a contract of adhesion where them write the contract, written and reviewed by themselves. You do not involve yourself in writing it. So they go to court. The judge may interpret that clause to be different altogether. And they're going to pay more because they pay the cost of court, they pay the lawyer, pay everybody. Now come back to settle you and now pay you time for wasting pay you the cost of wasting your time. And every other thing involved. So they will lose a lot if they go to court with you. Court case does not end one day. So put all this together. Insurance company do not want to go to law court with you. They want to avoid, they want to settle out of court. So when you do a waiver, you are waiving your provisional right you have to another person. If you decide to transfer the contract to another person, your daughter or your son, you are practically waiving your right to them. Now, Peru evidence rule, a Peru word in the context means verbal or spoken. It has nothing to do with criminal justice system. A Peru evidence rule states that only the written terms of an insurance contract are legally binding. Remember, insurance contract is always the 4 elements of contract, CLOC. You can remember. If somebody write it down, you can tell us what is CLOC. What is CLOC? I think everybody that started with us in this should know it. What is CLOC?
It's a competent legal legal
offer and acceptance.
Offer and acceptance and consideration.
Consideration. So that's CLOC. These are the 4 elements of insurance contract. That is the 4 elements of insurance contract. So If that contract is binding, means that those 4 elements must be there. So for that 4 element to be there, you must, however, they must be legally binding and they are liable to go to court. They will go, they will go to court. It become a court book. Then in any contract where where it is not documented, it cannot be presented. Something verbal or spoken word. Can you take verbal or spoken word to a court? No?
No.
No, you cannot do that. So the payroll evidence rule states that only the written terms of an insurance contract are legally binding. Only the written terms, the ones written down, is legally binding. The word of mouth is not binding. Spoken word is not binding. Of course, you tell somebody you are stupid. That is not binding. That's nothing. Also, it's an assault. It was not written somewhere. So if you go enter any contract with anybody without signing anything, it's not binding to you. So verbal statement or promise made before the contract was signed cannot override what's written in the policy. In other words, do not tell your client what you think that is not in the policy. Conversations between agent and client about coverage cannot change the actual policy terms. Do not go and tell the agent that, the customer that, look, this policy will build your house, when you know that you cannot build a house. If there's a dispute, the court will only consider what's written in the policy. Any changes to the policy must be made in writing through proper endorsement. So that's what we think of the insurance policy as the final word on that is not covered. So these are the things we should have in our mind. Here is how the payroll evidence rule works. An agent verbally tells a client during the sales meeting that their homeowner's policy covers all water damages. How can you tell a person that his homeowner's policy covers all water damages? It's lying. A written policy clearly states it excludes flood damage. In life insurance, there's what we call exclusions. Those exclusions are those things that the policy does not cover. They are exclusions. Those things that the policy does not cover are exclusions. There are some things that policy does not cover. Those things are exclusions. One of such things are suicide. If somebody dies of suicide, it's an exclusion in insurance policy. Policy does not cover it. No benefit. And that's suicide, the exclusion, particularly suicide, only for the first 2 years during the contestable period. After the contestable period, if that person dies of suicide, benefit will be paid. So please remember that.
Yeah.
So we have a lot of exclusions. Suicide is one. Pilots, those who go into war, all those are exclusions. Does it mean that those ones cannot get policy? Of course they will. But their risk level is on another level, meaning their premium will be higher. So a written policy clearly states it excludes flood damage, of course. A client's home is later damaged by a flood. So let me remind everybody here, I retired about November last year. And I come to find out what the kind of policies, insurance policies we have at our jobs. And normally, under law, that job we have, that policy we have on our job is a term policy, is level term policy. By law, since it's a single contract, our employers suppose have the contract, while we have the certificate of insurance. That is the law, what the law says. Meaning, at your job today, they're supposed to give you a certificate of insurance. In that certificate of insurance, you will know the exclusions. You will know what happens when the person dies. You know what happens when you are sick. You know what your benefit is. But almost all of us here, we are working. If you ask all of us here, what is the benefit if tomorrow you can no longer go to work? If tomorrow you are sick, what is the benefit in the life insurance the work gave to you? None of us will know. Why? Because the certificate of insurance, which the law specify that we go to the employee was not given to us. The employer should have the master contract and the employee should have the certificate of insurance. On the certificate of insurance, you can be able to see the insurance summary, policy summary. In the policy summary, you will know all those things. So when I retire, I'm now trying to convert my policy I have at work to a whole life insurance because you can convert that. So when I try to convert that, they ask me questions, say, how much is this? I don't know. And see, this answer I gave is what all of you will give. Does anybody know how much his or her own is covered? Please tell us. Does anybody know?
You mean the policy?
You have at your work. How much is it?
I think there are many insurance. They have this.
No, there are not many insurance. The policy you have insurance at work. You have life insurance. You have life insurance at work.
Group life insurance, right?
Group life insurance. You have it at work?
Yes.
How much is it? What?
I think probably like is it 100,000? It's within that range. Sometimes 100,000 or something. And they pay for it though. I don't, because that's why it's called group.
Oh, all right. No. You're making a mistake. We are going to see it. Is it? Let me ask you this question: is it contributory or non-contributory?
It's like the group life insurance. I don't even the employee doesn't pay for it. The employer pays for it.
That's the key.
So is it contributory or non-contributory?
Not contributory means I don't pay anything though.
Yes, non-contributory means you don't pay anything.
Yes, so
they're not taking anything from your paycheck.
No, they're not taking anything. That's why I said the employer pays for it.
So any other person that his own employee is paying.
I mean, that's why it's called group.
No, that's not why it's called group.
Yeah, because remember, this policy is bought by the employer for their employees.
That's the key. That's the key insurance.
They don't even negotiate the contract.
No, hold on. You're mixing everything.
Okay.
You see, let me tell you. I want you tomorrow, even if your paycheck is around, bring out your paycheck and check your paycheck. You see, let me tell you, in every group insurance, is either contributory or non-contributory.
Okay.
Most of the companies cannot give you non-contributory.
Okay.
Remember what I said about key employee.
Yeah.
They give you that group insurance, you pay, they use it to write off money.
Okay.
It becomes a company expense to them. Are they paying all? No. Highest you can see I don't, in fact, it's high. The only people they do non-contributory are the executives, and they use it to retain them, to make sure they are there. Most of the group policies are contributory, which means you are contributing some percentage to the premium.
Maybe I will double check my
check. So either you are contributing, or if your company is not contributing, my brother, remain there. Okay. Which means they are not taking any money from your paycheck to pay the group for the group policy.
Because I know they actually, if they are paying, if they want me, because me, I don't even want it. Because I know that it's not, if I leave the company, I'm not going to have it. So there's no need of me taking it. So
no, but if it is not, see, let me tell you, if it's not contributory, if it's not contributory, get it, take it. Because you're not losing nothing. They're not taking it from your paycheck.
Yeah, that's what I'm saying. If they're not, that's why I only take it if I don't have to pay anything.
Yeah, if you don't have to pay anything, you can take it. Yeah. But however, if you still need to pay something, if it's contributory, still take it, because what happened is if you check how much you can pay in term, because it's level term insurance, they call it group insurance, but it's level term insurance. If you calculate how much, if you go and buy the same amount of policy, let's assume the policy amount is 200. Now you go and buy term life insurance, level term life insurance of amount to 200, and you are paying $50 for that policy you bought, and you check the one you are paying your work is $50, then you can as well just leave that of work and pay your own and be paying $50, because that your own remains even if you go out of the job.
Exactly.
But if you now find out that those people are paying the for the term policy,
Yeah.
get it. You are not losing nothing. So, however, what we are still going to come to see all those in other chapters, or it will be clearer in other chapters. But why I begin to come to this level is that when I retire, they begin to ask me various questions when I'm trying to convert my policy to, because you can convert your group life insurance to individual whole life insurance. You can convert that when you get out from your job.
Yes, if you want to continue with the policy.
Yeah, you can convert that. You can make it become whole life insurance with cash value. You can do that. So I was doing that. They begin to ask me questions. I said, I don't know. The lady begin to laugh. Say, Mr. Pat, why you don't do it? I said, I don't know. The lady laugh. At the point is a Black American lady. So at the point, we become so her friendly. So she was laughing at me. So after the whole thing, we were just discussing. I mean, as an insurance agent, I'm trying to recruit her.
Oh, okay.
So I was talking to her. I said, I told her to give me her number. She said, you can't give me her number on phone. I said, all right. I called my number. She laughed. She picked. So after the whole thing, she called me. We now begin to laugh. I was trying to put her to see whether she can come in to begin to do the business.
Yes.
Now we begin to talk. She laughed. She said, look, Mr. Pat, I just deliberately asked that question because I know you don't know. And most people don't, almost everybody don't know.
No, she thinks you don't know.
Because do you have the insurance certificate? I said, no. So let me ask you, Mr. Obinna, do they give you certificate of insurance in your job?
No.
Anybody here, they give you certificate of insurance in your group life insurance in your job?
Why would they even give me certificate though?
Yes, the law said they should give it to you. Yeah.
Certificate of, is this certificate of as an agent or just for owning the insurance?
For the insurance they give you at work, your group life
being
insurance.
Part of the policy. Okay.
Yeah, the group life insurance they give you at work, the law says the employee should have the certificate of insurance, while the employer have the master contract.
I never get any, all the companies I work for, I never get any certificate from them. But
Yeah.
even I don't even want the insurance either.
So the reason is this: if you have the certificate of insurance, those questions I was saying I don't know, I would have known because I will see my certificate of insurance, I will know what it means. And that is where you know the exclusions. And one of those exclusions in group life insurance, which they don't want to tell you, and one of the reasons why they don't want to give you the certificate is exclusion that involves death. When will you die in a job and you are paid benefit? It's a very serious issue. If you die outside your job, you may not get benefits.
Yeah.
Then that's the more reason why you should consider if it's contributory or non-contributory. If it's not contributory, if it's not contributory, then take it. If it's contributory, check the amount, and you can now have an independent policy where if anything happened to you at any place that thing happened to you, there is a death benefit. So these are the things we have to check in our jobs. So let's look at extopol. This is another term that people get confused in exam. Extopol is that, I don't know whether I pronounce it correct, is a legal principle that protects what consumers when they rely on incorrect information from an insurance agent. So you are coming out to be an agent. You have a customer, you told her or him a wrong information. She believed on you. You told her that when she write this policy now, she's going to get cash back in the next 2 months, cash back of 200,000. The agent will write the policy based on the understanding that in the next 2 months, she'll get a cash back of 200,000. If that agent believes you and document it, now, next 2 months, he or she went to cash it and they did not give him that, the agent can sue you. And if he sue you, what happened? This extopol is what protects her. Meaning, you made a statement that's not correct, and agent believe on that statement to board the policy. The court will award the case to her, to him or her. You must pay him the 200,000, which means the insurance company you're working for we pay him that money because remember, as an agent, you represent the insurance company. So the insurance company must honor the promise the agent made.
What's the proof that she said
The
it?
proof, the agent must have documented it. That's the proof. So for extupel to apply, 4 conditions must all be met. 1, the agent statement. An insurance agent makes an incorrect statement about coverage. The agent must be acting within their authority when making the statement. 2, the client's action. The client believes the agent's statement. The client takes some action based on what the agent said. Example, a client changes their coverage because the agent says certain items will now be covered. The company's denial. A claim station occurs that they led to what? Agent's incorrect statement. The insurance company tried to deny the claim based on the actual policy language. The company refused to honor that the agent told what the agent told the client. Financial impact, the client loses money because they relied on what the agent said. The denial of coverage what causes financial harm to the client. If all these conditions are met, the law prevents the insurance company from denying the claim. Did you see it? So the company must honor what its agent told the client, even if it differs from the written policy. So remember, an agent represents the insurance company. So the company is responsible for what its agent tells clients. So you have to be very aware of what you tell a client. Tell him, do not tell him to convince him to buy a policy from you. Tell him specifically the truth. In fact, this business is not business of conviction, it's business of education. Because if a right-thinking person understands what insurance is to him or her, he will buy the policy. Of course, the same client, the same customer has policy for his house, or his or her house, has policy for his or her car, have policy for his, have insurance for the phone she's using, have insurance for the clothes she bought at Walmart, have insurance for everything he does. So the person who have the same person who have these policies for all this does not have a single policy for him or herself. Who owns all those? It's not an aroma. It's not it's misjudgment. Yeah, it's a misjudgment. If you buy a car today, before you drive off a car lot, you must have insurance on that car.
Yes.
If you buy a home today, before you can move into that home, you must have insurance on that home.
Yes.
Otherwise, they will not allow you to move in because they want to protect their money. Now, you that have all those things is moving around. If somebody tell you about insurance, you'll be as if you are helping the person. No. It's an education that we all should continue to tell our people until we understand. It is very, very necessary. No matter how small it is, get a little bit. Get as much as you can afford. It's a true story. Get as much as you can afford. When you get the knowledge, you can now get more to cover yourself so that you will not underinsure yourself. Remember what I said to you yesterday about underinsuring yourself? You have always to make sure that you have a full coverage for your life. If you go and insure your car, you have a car, you do liability insurance, it's not a full coverage. You do a full coverage, if you hit somebody, the insurance company will repair your car and repair the person's car. If you have liability insurance, you hit somebody, the insurance will go and repair the person's car, you go and find a way to fix your own.
That's liability.
That is a liability. A full coverage is where the insurance company is liable to, they must repair your own and repair the person's own. So you get a full coverage that if anything happens, at least you cover the amount that remains in your home. If you have at least for your home, because you don't want to live on the road or move to apartment. That's the only thing that can keep your home for you when there's any turnaround of events. You have a home that worth 250,000. That's what remains for you to pay it off. You want to buy policy, get a policy that can be able, if anything happens tomorrow, that can be able to cover that home. At least for that home to remain with you and your children. That is the most important thing. If it is to talk about the tax in that home, at least people can rally around to pay the tax. But to pay that amount, if anything happens, is a big trouble. So always get a policy that covers your home. So if anything happens, you know that you're not losing your home for anything. Yes. All right, so let's go on to payroll evidence rule and extopol. We have talked about extopol. Let's not go deep into it. The law of agency. Yes, this is one other area we should know. Remember, you enter into a contract with insurance company. If you're working, if you're with WFG, you have access to more than 100 insurance company. More than 100 insurance company, you can do business if you are an independent agent. But if you're a captive agent, you cannot, you only work with one company. So remember that, independent agent and captive agent. A captive agent is that agent that works only for one insurance company. An independent agent is an agent that has the ability to work for as many insurance companies as he or she can lay hand on. So WFG give you the platform to work with more than 100 insurance companies. You can do policy, you can do annuity, you can do all kinds. In fact, you can do your home and their car insurance. That's what people don't know. If you get this license tomorrow, you pass the exam, you can change the insurance in your home and still be paid commission in your home. You can become your own agent in your home. You can become your own agent in your cars. And you will also receive commission for being the agent. So you don't need to go to agent to buy insurance for your home or for your car. You do it by yourself. So these are the things that the license will bring to you, that are more beneficial to you. So as much as you live, as much as you continue to pay for your home, you are the agent, life insurance agent for that mortgage. You are being paid commission for that mortgage. You don't need to go and give it to another person. So all those loopholes that the money is going out of your house, you block them. That's something that can make somebody rich. You block the unnecessary loopholes that we are wasting money on. That's what an average person does to make sure that he got what is required of him. Are you going to pay all the tax that is due? Of course, legal tax, you must pay them. But there's some things, loopholes that we have to block. And the only way we can block them is when we know them that it's necessary to block. Yes, you can do that. They can give you series of insurance company. You choose the one that you think that is cheap for you. You choose that one. That one will cover your home. You become the agent. You will be paid what? You will be paid commission for that. You will receive that. Yes. Just like you can do your own annuity. I hope everyone knows that. You can do your own annuity and you pay commission on that. So there's so many benefits, but only you will know when you pass the exam and begin the training. You begin to see all the things that you can block. You block them off. You block them off. By the time you block them off, $2 or $1 coming from here, see that there's a change. So in any contract, become an agent before you write policy or before you enter any business with anybody, any insurance company. You must have to enter what we call agency law. That insurance company have to enter into contract with them. That contract is what we call the agency law. You have to follow what they do because it means now that you are representing the company. Whatever you say is assumed to be what the insurance company said. So an agency law enables the insurance company and you to enter into a professional agreement where you now represent the insurance company. Wherever you are, it's assumed that the insurance company is here. Whatever you say to the customer or to the client is assumed is the insurance company that said because you represent them. But you have to sign paper with them. In WFG, it's very easy. You don't go and sit down with them and write, no. They'll just send you an email. You'll repeat because everything has been documented and prepared for you through the master, which is the WFG. So this brings us to what the law of agency, which governs the relationship between insurance company and the professional who represents them. Who is the professional? You, the agent, the producer, and the feed underwriter. Remember the word producer. Normally, when you hear producer, you think it's the insurance company. Please, no. The producer is you.
The agent.
Is you, the agent. The feed underwriter is you. Those three words I can use to describe you. In the exam, they may use one of them. You may be confused. Say, oh, who is the producer again? It's you. Who is the feed underwriter? It's you. So the insurance company relies on complex network of relationship between companies, agent, brokers, and clients. Remember, the broker represents what? The client. He's the insured. You, the agent, you represent the insurance company and the insured or the client. So your mission here, when you begin to get your license and begin to do the job, is to become a broker. And again, be mindful of when you pass the exam to being lured into become a captive agent. Be mindful about that. So as noted earlier, an insurance agent is authorized to sell, solicit, negotiate, and effect contracts of insurance on behalf of the insurer. Who is the insurer? The insurance company. So your duty as an agent, when you have agency contract with them, your duty is to sell, solicit, negotiate, and effect contract of insurance on behalf of the principal. Who is the principal now? The insurance company or the insurer. They are regarded as principal in the agency law. So the insurer, the insurance company, or the principal means the same thing, depending on when it's used. More especially when you are talking about referring to agency, you're not referring to the principal. All right. So insurance agents, insurer grant agents authority to undertake what? Functions in their contract of agency with the company. So with the contract signed, you now become an agent to the insurance company. So this agreement may also be referred as agent appointment or agency agreement. When you sign that contract, it becomes an agreement. It's a contract between two of you. So be mindful, don't be agent. So this contract, what do we do? They clearly define the scope of agent's authority. In the contract, the insurance company will tell you what you do and what you will not do. If you go contrary to what they tell you to do, you're your own. However, to avoid you making mistake, the insurance company is protecting you. They want you to have what we call E&O, error and omission insurance. If anything happens, the error and omission insurance will take care of it. Of course, there's no way there'll be no mistake. So that's why it's mandatory. No insurance company work with you without error and omission insurance. E&O. Of course, in your different job, more especially those in medical field, you are required to have E&O that protect your license. So here too is a law. In medical field, it's not a law that you must have E&O, but those who are knowledgeable have E&O, particularly the doctors, the nurses, most of them have E&O policy. It's not expensive. But in insurance contract business, it's mandatory that you must have E&O, error and omission insurance. So let's look at the principles of agency law. By legal definition, an agent is a person or entity that acts on behalf of another person. Who are you acting for on behalf of? Is the principal. Now, who is the principal? Yeah, the insurance company. So, insurance company, the insurer, and the principal, they are the same thing. So in case if you see, don't be confused, please. Don't be looking about around say, who is the principal? Who is this principal? Principal is the insurance company, the insurer. So the agents represent the principal in dealing with third parties that concern contractual agreement. The third party is the customer. Authorized agent can create binding contract for the principal. You can create binding contract for the principal, which is authorized agent. So this contract includes what? Both right and responsibility. You always have right and responsibility, what you do and what you will not do. There are some things you will not do. There are some things you will do in the contract. So let's go ahead and now, based on the things you will do and the things you will not do on the contract, they are regarded as what? Express, implied, and apparent. So if you have your pen, you can write the 3 types of agents authority. the three types of agent authority. What are the three types of agent authority? Is always in the exam. These three things, one must come up in the exam. They look confusing, but believe you me, one must come up in the exam. So the three types of agent contract or agent authority is what? Express, implied, and apparent. We're going to see them what each of them mean. So we have what? The express, implied, and apparent. They are the three types of agent authority. Express, implied, and what? Apparent. That are the three types of agent authority. So you now sign the contract with the insurance company. Now the contract will give you authority on the things you will do and things you will not do. So those authorities are classified as express, implied, and apparent. Those authorities that you work with are the three classifications. So let's go to the three classifications, what they mean. The express authority. The authority given to you to work with is called the express. So what is this express? It's the express authority is the authority a principal deliberately gives to its agents. It's deliberately given to you. Those things that itemize for you to know that you work with. You must not go behind to do things that are not given to you to do. So in the contract, in the agency contract, if it is express authority, means that the authority refers to those authorities that are expressly stated in writing under the terms of the agent's contract. So express authority must be written down. It's a written authority. Just like when you get a new job, they say this is your responsibilities. What they call it, is a responsibility, they call it a job. They say the terms of the contract, what you will do and what you will not do. Your duty lines, they will write it down. So these are the express authority, they are written. It's the type of authority that's written, given to you, including your principal, give to you to work on. That is the express authority, written under the terms of the agent's contract. So they are the express authority, written. At least that's how you distinguish them from implied and the express. So what is the implied? Implied authority is unwritten. So express authority is written authority. Implied authority is an unwritten authority. Please, you can write it down too. Is an unwritten authority not expressly granted in writing. Is not given, is not led, in fact, it's not written down, but the express authority are the authority that the company write down, say, look, Mr. Paul, take your job responsibility. It's written down for you. Those are the express authority. Now, upon the express authority, there is what we call an implied authority, which you can work with again. And those implied authority are not written down as express authority was written down. So the unwritten authority are called implied authority. So please just know how I differentiate them. That will help you. So the implied authority, the agency assume that you have to know those. They are accidental to express authority because not every single detail of an agent authority can be spelled out in the agent's contract. So you not expect them to write down everything. You not expect them to write down everything. For instance, let me use this example. You come to work and in your table, when you are coming, your manager called you to the office and give you paper to sign. He said, please take it to your office and sign the paper for me immediately. You said, no, sir, or ma, please, can I sign? He said, no, take it to your office. I have something. Somebody's coming. Take it. So you take those into your office. You open your office. You look at your table. There's a coffee that poured in your table. And that paper is supposed to sit down to write it, to sign it. Are you going to first clean the coffee? Or can you put the paper on top of that coffee to sign? No. You first of all clean the coffee before you place your paper on the table to sign it. If you place your paper on the table to sign it and go back to your manager will ask you what happened to the paper. So it is implied that you should first of all clean that coffee before you can place the paper to sign. That is an implied authority. Again, another one is this. You are not in your work. You may have, if you want to have a business card, you can print up a business card. Your company does not specify that, look, Mr. John, print a business card to make your business easy. No. It's an authority. It's an implied authority given to you that you should print your business card. In this business, you are going to get a website free. When you pass your exam, you log in to WFG, they will give you website free in which you can do your business with. A website on your name, on everything you want to be on the website will be there. You can be referring people during that website to do business with you. So those are the implied. They are not forced. If you don't want, nobody forces you to go and get a website, open your website. But if you want a business to operate well, you can open the website. So if you want to print a card, you can print. It's an implied authority given to you already. All right. So apparent. We have talked about what? Express. Express, we say written. Implied, we say unwritten. Then let's look at the third one, which is called apparent. The apparent is based in action, word or deed of the principal. You go to your manager tells you to go and do that. That is an apparent authority given to you to work on. It's not written. It's a word by word or action. Or you see somebody, for instance, somebody spilled something on the water, on the floor. You know definitely that by implication, you should clean it up. Those are express. If you don't clean it up, you know what happened. Somebody can fall, trip and fall. So those are the apparent authority. Is action. It is based on what? Actions, word or deeds of the principal. You can just write it down for you to remember it. These three things, always you will see it in the exam. There is no way you cannot see one. Express, implied, and apparent authority. You want to know what they mean. You want to know what each of them mean, please. Express, implied, and apparent. You want to know what they mean. Express is written, implied is unwritten, apparent is appearance based on what? Actions, word, or deeds of the principal. Remember, the principal is the insurance company. All right, so this is the exam. It's a licensing exam frequently presents scenarios asking you to identify which type of authority is being demonstrated. Of course, this is how they ask it in the question. They want to know, they will ask a scenario question, they ask you what type of authority is that? Is it express, implied, or apparent? So how you identify the one that is express? Express is specifically written in the contract. What is implied? Necessary to do at the job. Is implied is necessary to do at the job. It's unwritten, but you know you do that. Then what is apparent? Apparent is word by action. It's word by action or by speaking word, or by the action of your manager. Those are what? Apparent. So now let's look at this scenario because these three words are very important. I want everybody to know it. Let's consider Agent Maria. For express authority, her contract explicitly states she can sell auto insurance policy. That is express authority because it's written down. Implied authority, she orders office policies with the company credit card, not explicitly stated but necessary for the business. You know, as a front seater in the company, you can order goods and materials for the company. Apparent authority, she has a company email address and business cards stating she is licensed agent, leading client to what reasonably believe she can bind coverage. So these are the three things. Please don't forget. Brokers versus agent. I have already said something about this. An agent is responsible to his principal and the insured. You are answerable to your principal and the insured. Who is the principal? The insurance company. Who is the insurance company? The insurer. So the agent is responsible to them and the what? The client or the customer. But the broker is responsible to what? To me, to the employed, to the insured only. So please, I want everybody to have that in mind. You must know that, please. You must know that. You must know that. All right. All right. All right. So, I think this is 4:10. I think we're gonna stop here. We're gonna stop here for today. I think I have another training now. We started almost 2 to 4:11, so we have tried for today. But definitely we're gonna finish this on Monday morning. If you have chance on Monday morning, 8:30 on Monday. We can start again 8:30 on Monday, please. 8:30 on Monday. This is 4 o'clock, so we can go and do what we're supposed to do today. Let not be that we are. Yeah. So.
Good evening, everybody.
So we are. You see, we are entering another meeting now. So.
Okay.
All right, please. So I see everybody tomorrow morning.
Okay,
On
thank you so
Wednesday.
much.
On Monday by 9 a.m. in the morning, please. So I have another meeting, another training now, which they have logged in. They're waiting for me.
Okay.
So see
you
you
so
guys on Monday by 9 a.m. in the morning.
I wish you have something in the evening too, as well.
Evening, please.
You mean today?
No, I'm talking about tomorrow.
On Monday.
No, on Monday. On Monday.
Yeah, on Monday, can we have something in the evening as well?
Yes, 6 p.m.
Okay.
Yeah. All right. See you guys on Monday morning, 9 a.m. and evening 6 p.m. All right.
Okay.
Have a good weekend, everybody.
You too.
Thank you.